Welcome back to Smart Stock Sam, the channel where we cut through the noise and find the signal. If you've been following along, you already know I flagged this exact scenario days before it unfolded. SoFi's CEO just dropped over $1 million of his own money into the stock. The moment his trading window opened, institutional giants are quietly tripling their positions, and the stock is sitting at a valuation so absurd, it's practically begging to be corrected. Today, we're breaking down why SoFi is primed to explode, what the CEO's purchase really means, and I'll give you my revised price targets with the exact levels you need to watch. This is the divergent story of the year, and if you're not paying attention, you are going to miss it. Let's start with what I call the Great Divergence, because right now, two completely different stories are being told at the same time. On one hand, you have the price action, messy, volatile, and looking broken to anyone who only watches the ticker. On the other hand, you have the actual business, which is firing on all cylinders and hitting records that most traditional banks would genuinely envy. If you've been staring at the red on your screen and wondering whether the SoFi story is over, I need you to stay right here, because the gap between what this company is worth and what the market is pricing it at has never been wider in its history as a public company. Now let's talk about the engine powering all of this, because the numbers are not subtle. SoFi just crossed the $1 billion quarterly revenue mark for the very first time. That's nearly 40% growth year over year. And for anyone who spent the last 2 years calling this an unprofitable tech experiment, they just delivered their 9th consecutive quarter of GAAP profitability, posting $174 million in net income. This is a business that has completely decoupled its structural profitability from the emotional swings of the broader stock market. The fundamentals are not deteriorating, they are accelerating. So here's the question you have to ask yourself. If a company is putting up numbers like that, why in the world is the stock not trading at a massive premium? Well, the answer is the most exciting part of this entire story. When we map SoFi's earnings growth against the current stock price using the PEG ratio, the tool professional investors use to determine if a growth stock is expensive relative to what it's actually earning, the result is shocking. A PEG ratio of 1.0 is considered fair value. SoFi is sitting at 0.64. That is deep institutional grade value territory. Wall Street is projecting 54% earnings growth for 2026, and yet the stock is trading like this company is going backward. Every serious deep value screen on the planet is lighting up for this name right now. But what's a great valuation without a real moat protecting it? And this is where SoFi just built something that legacy banks simply cannot replicate overnight. They've now scaled to nearly 14 million active members. And then they made a move that no other institution has pulled off. SoFi officially became the first United States chartered bank to support direct on-chain Solana network deposits. Let that sink in for a moment. They are fusing the ironclad legal protections of a federal bank charter with the cutting edge of digital asset infrastructure. This is not a bank that is dabbling in fintech. This is a technological fortress. And could the big legacy banks figure this out eventually? Maybe, but by that time, SoFi will already own the next generation of financially active customers. So if the business is this strong, if the technology is this advanced, why did the stock just get crushed 7% in a single day? On February 27th, SoFi's price action completely detached from its fundamental reality. A 7.02% crash snapped the critical $18.50 support level, sending shares all the way down to $17.76. Volume exploded to 115 million shares. The culprit? A hot PPI inflation print spooked the algorithms, and shifting sentiment around S&P 500 inclusion triggered a wave of retail capitulation. People panicked. And that panic created exactly the kind of opportunity that separates long-term wealth builders from short-term noise traders. Because while retail investors were frantically hitting the sell button, the smart money was doing the exact opposite. Nearly 48% of Friday's enormous volume was routed through dark pools and off-exchange swaps. For those unfamiliar, dark pools are private trading venues where large institutions execute massive orders without moving the public market price. In plain English, the institutions were using that retail panic as a liquidity event. They were catching that falling knife because they knew exactly what those shares were worth, even when the broader market didn't. And we're not talking about small players here. JP Morgan Chase, one of the most powerful financial institutions in the world, added over 17 million shares, a 37% increase in their entire position. And Citadel Advisors, one of the most sophisticated hedge funds on the planet, increased their stake by 234%. 234%. When the smartest money in the game is tripling their bet on a single name, you have to stop and ask yourself, what do they know that the panicking retail sellers are missing? Well, they likely saw exactly what the CEO saw, and his move on Monday was a masterclass in conviction and timing. The moment CEO Anthony Noto's legal trading restriction lifted on March 1st, he did not wait. He did not think about it. He did not schedule a meeting. On March 2nd, he stepped into the open market and purchased 56,000 shares at an average price of $17.88, deploying over $1 million of his own personal capital. This was not a programmatic purchase through a scheduled trading plan. This was a deliberate open market statement. Noto effectively put a $1 million personal floor under this stock at $17.88, telling every investor watching that the Friday sell-off was not a warning sign, it was a gift. And the market's reaction was almost immediate. Monday was a battle from the opening bell. Pre-market, the stock dropped as low as $16.50 on geopolitical turbulence involving the United States and Iran. Could that geopolitical situation have spiraled into something much worse and taken the broader market down with it? It's possible, but it didn't. Instead, we opened at $17.15 and grinded higher throughout the entire session, closing at $18.41, a 3.6% gain on above-average volume. And then, once that Form 4 insider purchase filing hit the wire after the close, the stock spiked all the way toward $18.82 in post-market trading. The conviction signal was undeniable. Now you might be wondering, can any of this hold up against the macro headlines we're seeing every single week? And that's a fair concern. Right now, there is a genuine tug-of-war between geopolitical risk-off volatility and SoFi's recurring $1 billion profit engine. But here's how I think about it. That profitability is not a one-time event. It is a structural shock absorber. Morning dips driven by headlines are being met with real institutional demand, because the underlying cash flow creates a definitive fundamental floor. The local bottom, in my view, is likely already in. That said, the next 2 weeks are going to be a gauntlet, and you need to be watching the calendar closely. This Friday, March 6th, we get the United States jobs report, which will directly dictate where Treasury yields go next. Then comes the big one, the Federal Reserve meeting on March 17th and 18th. These are volatility injection points. If the macro data comes in cool, SoFi has the green light to run hard. If it comes in hot, we test those support levels one more time. Either way, know your levels before the print, not after. And there is one more catalyst hiding in the shadows that could trigger a move before the Fed even opens its mouth. Short interest on SoFi is currently sitting at 10%, with a days-to-cover ratio of 1.9. Now look at the options chain expiring this Friday. There are massive walls of open call options sitting at the $19 and $20 strike prices. If the stock clears $19, market makers are mathematically forced to hedge their exposure by buying the underlying shares. That buying pressure then pushes the price higher, forcing even more hedging, which pushes the price higher still. That is a gamma squeeze. And could it happen so fast that it leaves most traders completely flat-footed? Absolutely. That is exactly how these setups work. So here is your tactical playbook. For a confirmation entry, you want to see a sustained hold above the 50-day moving average at $18.55. If you prefer an aggressive entry, the zone between $18 even and $18.25 is your primary psychological support. Your absolute critical floor is $17.50, which aligns with the low end of Anthony Noto's personal buy range. If we are above $17.50, the bulls are structurally in control. On the upside, immediate resistance sits at $19 and then $19.50. If we break through those cleanly, the next major technical hurdle is $20.30, but our full gap fill target, the destination this stock is logically heading toward as the valuation disconnect resolves, is $22. That is not a hope, that is a math problem, and the math is starting to work itself out. Before I give you my final verdict, I want to give you an important reminder. Nothing in this video is financial advice. I am not a licensed financial advisor, and everything shared here is purely for educational and entertainment purposes. Investing involves real risk, including the potential loss of your entire principal. Always do your own research, consult a qualified financial professional, and never invest more than you can afford to lose. The stock market does not owe anyone anything, and past setups do not guarantee future results. With that said, here is my verdict. This is a strong buy. The record business fundamentals are finally overriding the temporary market noise. Insider and institutional buying have established what I believe is an unbreakable floor, and the technical structure is primed for a decisive move through $19. The irrational divergence between what SoFi is worth and what the market is currently paying for it is closing, and it is closing fast. Here is the question I want you to answer in the comments below. Do you think Anthony Noto's $1 million open market buy is the single most bullish insider signal we have seen from a major fintech CEO, or you need something bigger to make up your mind for buying this stock? I genuinely want to read your thoughts on that, and if this video helped you see something you were missing, hit that like button. It helps more people find this channel and make more informed decisions. Subscribe to Smart Stock Sam so you never miss a breakdown like this one. The bulls are back, the divergence is closing, and I will see you in the next one.